Hello, everybody. In this session, we are talking about capital structure. Capital structure describes the mix of a firm's long term capital, a mix of debt and equity. That is, uses to fund its ongoing operations and future growth. A company's capital structure is reflected on its balance sheet. Investors may analyze a company's capital structure on its balance sheet to assess if it's a strong investment. Debt and equity are two of the main ways a company can raise money. A company's debt typically includes its short term borrowing, long term debt, and a portion of the principal amount of operating leases and redeemable preferred stock. Equity is a company's common and preferred stock plus retained earnings. And then, how does a capital structure work? Capital structure works by determining the proportion of debt and equity financing a company uses to fund its operations and investments. This decision is influenced by factors such as the company's risk tolerance, cost of capital, and financial goals. By leveraging debt, a company can benefit from the tax deductibility of interest payments and potentially lower its cost of capital. However, too much debt can increase financial risk and affect the company's ability to meet its obligations. Equity financing, on the other hand, dilutes ownership but does not require periodic interest payments, offering more flexibility in challenging economic conditions. And then we move to importance of capital structure. Capital structure is vital for a firm as it determines the overall stability of a firm. There are some of the other factors that highlight the importance of capital structure. We start from the first. A firm having a sound capital structure has a higher chance of increasing the market price of the shares and securities that it possesses. It will lead to a higher valuation in the market. And then the second, a good capital structure provides firms with the flexibility of increasing or decreasing the debt capital as per the situations. And then the third, a good capital structure ensures that the availability funds are used effectively. It prevents over or under capitalizations. Fourth, A proper capital structure helps in maximizing shareholders' capital while minimizing the overall cost of the capital. And fifth, it helps the company in increasing its profits in the form of higher returns to stakeholders. And then, what are the full form capital structure components? The first component, debt. The capital borrowed from creditors as part of a contractual agreement where the borrower agrees to pay interest and return the original principal on the date of maturity. And then the second, preferred stock. The capital provided by investors with priority over common equity, but lower priority than all debt instruments, with features that blend debt and equity. And then third, common equity. The capital provided from investors in the company in exchange for partial ownerships in future earnings and assets of the company. And then we move to a role of equity and debt in capital structure. Equity and debt play crucial roles by contributing distinct attributes that impact financial flexibility and risk management. Equity, representing ownership in the company, provides investors with a share of profits and voting rights. It affects businesses' flexibility in times of financial strain as equity holders bear the risks and potential rewards. However, equity issuance dilutes ownership and may limit the company's control. On the other hand, debt, sourced through loans or bonds, introduces financial leverage and entails fixed interest payments. Debt financing allows organizations to benefit from tax advantages and maintain ownership control. However, it involves the obligation of timely repayment. Striking the right balance between equity and the cost of debt is crucial for several reasons. Besides influencing the cost of the capital, it can also lead to risk exposure and affect financial stability. And then we move to types of capital structure. There are the different types of capital structure of a company. The first, equity-based capital structure. In an equity-based structure, a significant portion of the funding comes through issuing equity instruments, and this include common and preferred stocks. Investors who contribute capital through equity become partial owners of the company. The rate of return remains linked to the company's profitability. Equity-based structures offer flexibility as they do not include fixed interest payments. However, they dilute ownership among shareholders. And then the second, debt-based capital structure. A debt-based structure relies predominantly on borrowing through loans or bonds. It helps meet financial obligations and fund operational activities. Unlike equity, debt represents a contractual obligation with fixed interest payments and principal repayment. Debt financing provides tax advantages and allows your company to maintain ownership control. However, it also introduces a higher financial leverage ratio and interest rate risk. I think it is enough for this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe, and share. Thank you.